Hi, I'm Eric Silverman, and you're listening to the Passive Investor Show with John.
The views and opinions provided on this show are for informational purposes only and should not be misinterpreted as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, please go to passiveinvestorshow.com. Hey PI listeners, this is John Fortes. I'm making it a point to speak to as many investors as possible. My goal is to position myself to be a blessing to my network through conversation. How could one be a blessing through conversation? The easy answer is by listening. A simple conversation can open many opportunities and doors. I always ask myself this: what do I have to lose by having one more conversation? Going back to high school, I've connected friends and family in my network to one another, even if it didn't benefit me. And I continue those same principles and practices. Why? Because it's the right thing to do. If I can't help you, I probably know someone or something that can probably solve your problem. I'd love for you to become a part of that network. Go to www.johnfortes.com, create your investor profile, and schedule a call. How can I best serve you through conversation? In the words of Clarence the Angel from It's a Wonderful Life, no man is a failure who has friends.
And now, the Passive Investor Show. Here's your host, John Fortes.
Welcome, PI listeners, to the Passive Investor Show. I'm the Passive Investor Consultant, John Fortes, your host of the only ranked podcast for passive investors in multifamily syndications and real estate funds. Our goal and purpose of this show is to be a resource to investors and help them master their passive investments by beating inflation 1% at a time. My guest today is Eric Silverman. Eric Silverman is the co-founder and managing director of Eastham Capital. Eric is responsible for overseeing all operations of the company. Eastham Capital invests in properties sourced and managed by a diverse network of local and regional real estate owners and operators with successful track records. Eric is a Bowdoin College grad with an AB in mathematics, earned his degree of Masters of Science in Management with a concentration in finance from MIT Sloan School of Management, also a founding director of Leader Bank in Arlington, Massachusetts. Eric is also on the board of the Spalding Rehabilitation Hospital Network Partners Continuing Care. Welcome to the show, Eric.
Thanks for having me, John.
You are pretty accomplished. I'm excited to have you here. We've had multiple conversations in the past. And tell us about your background and how you got here.
Sure, it'd be my pleasure. So try not to tell too long of a story, but it starts from where I'm born. I was born in Detroit, Michigan. My dad was a real estate developer. So I've always been around apartments, primarily built apartments, primarily suburban garden style apartments around Michigan and the Midwest. And so I grew up around that in the 70s and into the 80s. I got the hell out of Detroit, went to Bowdoin, went to MIT, and I've always been around real estate investing. I did not go into my family business. I do stuff like my family business, but I didn't go into business with my family.
That's awesome. So basically, walk us through when you first started doing your own business and not going with the family business, and then how that came to be with working with investors today.
Sure. Well, I'll tell you the Eastham Capital story. Well, I'll quickly tell you my story. So I was entrepreneurial. I started a mortgage company, a residential mortgage company, pretty much right out of college. That led to, frankly, a relationship with Sushil Tuli, who founded Leader Bank. And I was together founding Leader Bank with him, me as, a board member and an investor, not as an operator. And that was almost 20 years ago. So that business kind of led to eventually my involvement in Leader Bank. In terms of Eastham Capital, 25 years ago in the mid-90s, I started investing in suburban garden style apartments, primarily in upstate New York, with my current partners in Eastham Capital. And we made those investments on a deal-by-deal basis. I was the passive investor. They were the operating partner. And they presented me deals, and I bought those. I made those investments on a deal by deal basis, you know, 25, 50,000, maybe $100,000 per property for myself, amongst other investors that, you know, pooled up to $1 million or $2 million, whatever the equity was. And we had a really good success there. And we ended up selling all those properties between 2005 and 2007, not because we're smart, but because people came to our door and started offering us ridiculously high prices. So we sold. Right after that, in 2007, we started Eastham Capital because we said, if we can do this in upstate New York, you know, dull, boring upstate New York, there's a lot of apartments out there, and I bet there's some great operators out there. So the product, that business model, that business idea led to Eastham Capital and looking for these joint venture partners to buy properties with. Can I tell you kind of where we are from starting that?
Absolutely.
So we started in 2007. We raised our first fund. It was a $10 million fund. My partners and I were two of the 10 million. We had about 40 investors. They committed capital to that very first fund in 2007, brand new fund. Never invested in a first time fund, but we got a few people that were, you know, drunk or dizzy enough to do it. And it did pretty well. We bought properties during the financial crisis. It was hard to find properties to buy. We partnered primarily with one group out of Texas, and they're still our partner today. Over time, over 13 years, we've bought over 40 properties with them, done very well on them, made money on every property we've bought with them, and still own, I think, 13, 14 properties today. We've grown that group over time. We've grown through funds. We've grown through funds 2, 3, 4, and 5, all more and more money under management. We're currently raising fund 6, which is a $400 million fund. And we currently have 12 active joint venture partners. But let me just say, John, that we've talked to over 2,000 groups across the country, over that number, to have invested with 15, of which we're active with 12 today. Now, and we own 44 properties in 11 states with 12 operators.
I think that's awesome. We'll get into the investing side, where how you vet your passive investors, but also you do vet your JV partnerships. Can you dive into how you vet your JV partnerships with your current boots on the ground operators?
Sure. Well, that's my special sauce. The first thing I'll tell you is that all of our JV partners self-manage. We do not hire third-party management. Third-party management is a large part of the multifamily apartment business across America for all different deal classes and sizes. I don't think it's a bad business. It's just not what I'm looking for. I'm looking for, let's call them vertically integrated, you know, groups that are local to a market, which is my rule number 1 of my 5 rules. They have skin in the game. So we're typically 80-20 investors on the equity, put up 20% of the equity, not 5 or 10% or less. And they self-manage, and we're making a subjective decision of their management capacity. And that really is a subjective decision. So we're talking to their competitors in the market. We are calling their properties and checking on them. We are talking to them sometimes for years and years until we finally do our first investment with them. So we're constantly in the market, talking to operators, trying to figure out who's doing the right stuff in that market and is that vertically integrated group. Many private equity funds don't need that, don't choose to do that. They choose to hire third-party managers. It's not a problem. What I say is third-party management is great, just not for my assets.
I love that. And now you mentioned you as a passive investor before, and then
Yes.
Eastham Capital came to be.
Yep.
But went away from the one-to-one and syndication raise. Why?
Right. Deal by deal. We moved from deal by deal to a fund. Go ahead.
Why the fund?
Yeah, because we realized that we needed to have ready capital to invest. And investing in deal by deal, which I had been the investor and my partners had been the, you know, raising the money from me and others, it's hard because sometimes the timing doesn't work so well. And they want, and we wanted to be money good. We wanted to, if a JV partner, a potential partner of ours came to us and said, I need $3 million to buy this property, we wanted to say, we got it. We got you back. We're there. We're ready to invest the money. Don't worry about the money because we have it and we'll do what we say we're going to do, and we close. And that's our reputation in the market.
I love that. I love the fact that you took it out of the one-to-one model and created the fund to have it ready. And when you have dry powder, you're able to take advantage of opportunities that
Correct.
might not be there if you had to raise it, right?
Correct.
Awesome.
I will say there are some great vertically integrated deal by deal operators, huge, large, very, very good. Some use third-party management, some don't. There's a lot of ways to skin this cat.
I love that. I love the fact that the business itself is, you could do either or, and you can be you in the process. So
Yep.
Thank you for sharing that, man. How are you coming across investors that are interested in your funds?
Well, so we have a track record now, and we've had multiple funds. So let me tell you, Fund 6 is a hell of a lot easier to raise than Fund 1. And Fund 2 was no party because that was in 2009 and 10. Everybody wanted to jump on investments in 2009 and 10. That was a great time. Not. Although those were, of course, that's our best fund ever. Fund 2, which we raised in 9 and 10, mostly in 2010, had a 30 IRR net, a fund. It's crazy. And we doubled money. It's crazy. So anyways, what I want to say is that we've built a book of investors, and every time we raise a fund, we're able, through repeat investment, that typically 2/3 to 3/4 of the capital and people that we get to invest are repeat investors. But we always need to add fresh blood, new investors, every few years. So I'm in the middle of that right now. And my numbers are a little staggering right now. So our current fund, Fund 5, the one that we're finishing investing, has 460 investors, 460. Many of whom were in the prior funds, but not all, because the prior fund was 300 investors. So I added a bunch of new investors in Fund 5. In this fund, I expect to add 150 to 200 investors. Many, many, many of them come from personal referrals, from referrals of other investors, and then referrals and referrals. So it's that building up that track record, experience, and referrals. And here's a crazy one for all you salespeople out there: ask for referrals.
I'm laughing on mute here, so as I'm enjoying your story and the way you're presenting it. Are you doing any marketing as well? Are you doing any ads, social media ads, or anything like that? Because of the fact that you have to inject new blood, right, with each fund.
Yep. So we could, but we don't. We could, but we don't. We tend to take a pretty conservative approach to marketing. The marketing, the outbound marketing that we do is that we learn this through doing, is we learn that a lot of wealthy people use wealth managers to help them manage their money. And we learned very early on that it was a waste of time going to the very big firms like Merrill Lynch, Goldman Sachs, Morgan Stanley, et cetera, because they're looking for something else. But there are thousands of RIAs, registered investment advisors, wealth managers, that manage other people's money. And we typically target the ones that are a little on the higher end. Typically, they're the RIAs that are handling people with, say at least 2 or 3 million and maybe $5 or $10 million of investable assets or more. And over time, every fund, we're able to add 2 or 3 RIAs. Now, mind you, I probably, between myself and I actually take my analysts that their day job is looking at properties, and I get them pitching the fund for just a few months as we're doing this. We'll call probably 4,000 to 5,000 RIAs over the next 6 months. And hopefully we'll get some meetings, and hopefully a few of them will encourage their investors to invest with us. But it's a very giant funnel to a very few opportunities, like usual.
That's a pretty interesting process. I love the fact that you don't go and spend on the marketing, but you do all the hard work. And I'm sure you're scraping these RIAs companies, pulling a list together to go ahead and contact and reach out.
Do you want to hear the story about how I did this the first time?
Yes.
Do we have enough time? So 2009, we raised the fund in 2007. We're investing it in 2008, Fund 1. 2009, we say, okay, we got to start putting together Fund 2 because we're running out of money to invest. We put the fund together and we learn about this wealth management world, okay? I'm not saying I shouldn't have known about it, but I didn't figure that one out. I figured it out, and then I found this list from some magazine that is sold to RIAs, the big dogs list. 500 big dogs of wealth management. So I called 500 people. I cooked the list. I put it into a spreadsheet. I got the phone numbers. I got the people's names, and I called 500 people, and I raised 2 accounts.
What are those conversations?
Well,
how did conversation 1 differ from the last conversation?
Well, 3/4 of them, 2/3 to 3/4, only invested in securities, listed stocks, maybe mutual funds. Okay, that's easy. Also knowing who you're not going to sell to is easy. So I'd say 1/4 to 1/3 would even look at an alternative investment. Private equity would be an alternative, like venture capital, private equity, whether it's deal by deal or funds. So now I'm down to 100 or 150 of these groups. And then I would go through them, and they'd mostly say no. No, you're a second time fund. No, we don't like that space. We think that self-storage is the way to go, or we think this or that. It doesn't matter. I mean, look, people have opinions and they voice their opinions, but a few of them, dug deeper, and a couple of them signed up, and then they had their investors come and invest with me. I will say I didn't pay them a penny. Maybe if I had paid them money, I would have more, but I don't like paying people for what I can do on my own.
I love it. I love it. Now, when a new investor comes on, what does your onboarding process look like for a passive investor?
Sure. Well, we have a subscription agreement. Well, but let me start from the marketing end of it. So let's say someone's introduced to me, okay? I have an existing investor. They say, you got to go call Bill Smith, who's not a real person. So I write to Bill Smith and I send him my investor presentation, which is about a 20-page presentation. And I say, if you'd like, we can set up a call, or set up today a Zoom call. Get that call, talk him through the information. And if he likes what he sees, I say, well, then I'll send you our private placement memorandum, which is the big giant document, and our subscription agreement. Read through it, call me, ask me more questions. And some people need 1 call and some people need 10 calls. And that's normal sales as well. Committing the time, committing to other people's schedules. When I'm buying deals and when I'm putting money out, it's my time. I set the schedule. When people are investing in me, it's their time. They're setting the schedule. It's not my schedule anymore. It's their schedule. It's my investor's schedule. So if someone wants to talk at 7 o'clock tomorrow morning, like I got a guy coming, wants to talk at 7 o'clock tomorrow morning, I'm on the phone at 7 o'clock tomorrow morning. Bright and early. And if someone wants to talk at 9:30 at night, I'm on at 9:30 at night. You like nights and weekends? Join the club. So because I'm on somebody else's time when I'm raising money. So there's a process. And then eventually they fill out the subscription agreement. They forget to sign in 3 places, but luckily I've got a person in my office who writes them back and says, well, you actually have to sign these things too. Then they sign them and then we have them.
And when are they going to the investor portal?
That's a good question. So we start setting them up in the investor portal, and they'll be all set, ready to go, but we won't open up that investor portal, I don't think. Maybe once we have a signed commitment from them and we actually have the physical document, we'll put them in their portal. We use a portal called advertising for Juniper Square. We were, very slow to get on the portals. We didn't even have one for Fund 4, but we did adopt one in 2017. Probably started working on it in 2016 for Fund 5, and we will certainly put Fund 6 on there. We've committed to do that. And with the investor portal, as you probably know, is very robust, and people can find out all the information. Doesn't mean they still don't call you and ask for their K1, even though it's on the frickin' portal. But, everything's on the portal. Every email we send out, every capital call, every distribution, every investor, everything is there. So some of it's training that, once they've committed and once they're in the fund, everything's there, and trying to get them to log in and use it, but it doesn't matter. Most of them still call and ask for their whatever. It's okay. It's human nature.
I love it. Now, Eric, what is the kind of impact that your investments have had on your passive investing?
The impact my investments have had on I've made money, so I got to do more.
I love it. Have you had conversations about, hey, Fund 2 was awesome. When are you going to open up Fund 3? Was there rushes to open up funds? No,
there's never a rush because...
Well, a request.
Yeah. Oh, all the time. all the time. I get all sorts of requests. People want to invest in a fund that I raised 3 years ago. No, you can't. I mean, I'm sorry, you can't. You can invest in the new fund. People want, there's a variety of things that people want. And so the other thing is you got to be who you are. Like John, you said, you got to be who you are. And then you got to build your business the way you want your business to be built. If you build your business the way everybody wants you to build, you don't have a business because everybody wants different things. So we had to build a business that fit our model, that fit my business partner, Matt, and how we wanted to work. I will tell you, we have those 460 investors in the current fund, and we'll probably have over 600 in the new fund. One deal. I've got one deal. There are no fee discounts, fee premiums, different timing. Everybody's got the same deal. I think we're unique in that way. Almost every fund I know, whether they're raising from individuals, families, or financial institutions or endowments, pension funds, et cetera, they've got these side letters, they got special reports. I don't have that. And there are people that won't invest in Eastham Capital because they don't get a fee break, or they don't get this, or they don't get that. And that's, I look at it as their problem.
Part of the game, your rules.
Part of the game. You got to be, it's the rules and being consistent and offering a consistent product. Communication, man. We are a very active communicator. Once they become an investor, very active communicator. And what's nice about our fund, even though we're quite large now, is you pick up the phone and you call Eric Silverman or Matt Rosenthal. You can talk right to us. We're here. We're taking the calls. What do you know? What do you need?
Love it. I love the communication. I love everything you just said. And you know what I love? I love that you answered some of the questions that I didn't even have to ask you. That's pretty cool. Eric, one piece of advice for the PI listeners.
I think now we're talking about the people investing in real estate as a passive investment.
Yes.
So diversify. You can either diversify by doing multiple deals with different groups, or by doing a fund like mine, or doing both. But don't put all your eggs in one basket. It's a pretty simple investment advice, but I think that people get excited. They get excited about something. They think, oh my God, this thing is going to be really great. I want to, and they write, a bigger check. Write a smaller check. By the way, you will infuriate guys like me that, would like you to write bigger checks, but that's okay. That's okay. Diversification will really save you in the end. Now you can also over-diversify. You can over-diversify, and then, but you'll know that when you over-diversify and you have too many K1s and too much to do, and then you'll wake up and do a fund.
How can we stay in touch with you?
easthamcapital.com. See this? easthamcapital.com. That's my website. I got my 5 rules up there. We didn't even go through those. We should do that sometime.
You know what? You want to go through your rules? We're not done.
Oh yeah.
We're not
I want to go through the
your
rules.
5 rules, Eric.
I got 5 rules. I go to apartment conferences and they're like, oh yeah, Eastham Capital, 5 rules. So everything we do is an apartment complex. It's in the United States of America and it's for rent, not for sale. And everything we do is a joint venture. We don't just go buy stuff. We have 5 rules. The first 3 relate to our partners, our joint venture partners, our manager developers. These are also called sponsors and JV partners, et cetera. These are real estate groups. There's thousands of them across the country. Number 1, they have to be local to the market. Local means they own in the market already. So you passive investor, when you hear about this great deal in Florida from guys that have never invested in Florida before, don't do that one. You can do their 5th deal, but don't do their first deal. I'm sorry for these sponsors that go do a first deal in a new market and think everybody should follow them. They should go do it with their own money. Local to the market, really important. Number 2, skin in the game. Okay, when you're reviewing these documents and you're a passive investor and you're looking at the deal, how much is the sponsor putting in? Okay, if the sponsor is putting in less than the acquisition fee or the fees that they're taking on the closing of the purchase, run away, stop, run away. They're taking no risk. They're just closing a deal. They don't give a what happens after the deal starts. Make sure they have skin in the game. These are easy rules to follow. Number 3, this is particularly Eastham. We only invest with groups that self-manage. I'm sure there's a lot of passive investments that are great investments with partners that hire third-party management. But do be careful that they're hiring the right third-party management and grill them on why are you hiring this manager and what is their experience in this market, okay? You don't want them not to be new. Now, number 4, we fix properties, not neighborhoods. I don't think like a developer, okay? I don't say I will build it and they will come. I say they're living down the street, they're paying $1,000 rent at a property that looks just like my property, but I'm buying it and it's getting $800 rents. Of course, the $1,000 rent property looks nicer, is better managed, but can I buy the $800 rent property, fix the deferred maintenance, improve my capital, and get it up over 3 or 4 years to get $1,000 rents? It's fixing the property, not the neighborhood. We are not a qualified opportunity zone. We're not a 1031 exchange. There's a bunch of things we're not. You can go do those. Those are great, just not with me. Rule number 5, we only invest in properties that can achieve a 10% cash on cash return post-renovation. This is a really high bar. This was a really high bar in 2012 when the market had more of these. These are really hard to find, but cash flow is the ultimate risk mitigator. We went into the COVID crisis with 44 properties, over 10,000 units that meet all 5 of these rules. And all of them were cash flowing or well reserved going in day one, with groups that were local, had skin in the game, self-managed, and we were fixing properties, not neighborhoods. That's why our properties have performed really well during COVID, because we followed these 5 rules. It's really hard to be an opportunistic real estate investor and follow rules. So my opinion is make up some rules, steal mine, add some, subtract some, get some rules, make some passive investments, not one, but a bunch. Good luck.
I love the way we just closed the show. I think you just dropped the mic on that one. Eric, I got one last question. It's my favorite question. What is the meaning behind your company name?
The meaning behind my company name. Did we do this before? Have I told you before? Maybe not.
No,
doesn't matter.
No, it's my favorite question to ask every show.
All right. So Eastham is on the Cape in Massachusetts, but that's not what this is. This is a totally different Eastham. So do you see that crest above me? That is the crest of the town of Eastham in the London dockyards. That crest goes back to the 10th century, 11th century, something like that. We stole that crest off the internet. And the reason we named ourselves Eastham is because the predecessor business, the one that we were buying all the deals in the mid-90s and 2000s in upstate New York, is called Stratford. And there's also a place, there's Stratford-upon-Avon, but there's another Stratford in the dockyards of London called Stratford, and Eastham is near Stratford. And my business partner, Matt, said, here's 3 places we can call this. We can call it Eastham, XYZ, and PDQ. And I said, I like Eastham best. Then I found the logo, and that's Eastham Capital. Ta-da.
I love it. I'm laughing the whole time. It's one of my favorite questions to ask. I just love how people come across or come up with the idea of what they name their company.
Okay, I thought I had told you before. That's why you were asking me, but you just like it in general.
No, it's one of my legit favorite
cool.
questions.
You get a story, you get the real deal.
Eric, thank you for coming on the show. It's a pleasure to have you. I appreciate it.
Thanks a lot, John. It's my pleasure.
Don't forget to download your free copy of the investment tracker. It allows you to track up to 5 investments, compare sponsors, markets, and most importantly, projected versus actual returns. To get your copy, go to www.projectedreturns.com. PI listeners, thank you for listening. As always, we hope this was the best resource for your investment strategy, but also the best use of your time. Remember, if this episode helps you, you can help us by leaving a review on iTunes. I hope you feel compelled enough to share it with someone you think this would resonate with as well. As much as it pains us to leave you, but you know what time it is. Time to go put this into practice. Till the next time we meet, happy investing. PI listeners, I'm grateful for your time and I appreciate you for listening. It would mean the world to me if you went to iTunes and left a rating and written review. Let me know how you feel about the show. It really makes a big difference with getting the podcast out there. Don't forget about our Facebook group, where all of our guests are members of. I'll be there to answer any of your questions, or even questions you might have for future guests. Subscribe so you can get the latest episodes and our fan favorite quick hitters. Finally, I want to keep you updated, so head over to johnfortes.com and sign up for the newsletter. If you're interested in partnering with me, sign up on the contact page so you can talk to me directly. I look forward to connecting with you. Happy investing.